So there are four financial statements that all public companies that trade on stock exchanges are required to prepare, and I'll discuss them in the order in which they are actually prepared by the companies themselves. So the first one is the income statement. This is where profit is calculated. It's pretty simple. Basically, you start with your revenues, you subtract your expenses, so then you're left with net income before tax, and then you deduct the taxes that the company has to pay, and then you arrive at net income after tax. But there are different levels of profit that are calculated. For example, gross profit is calculated as the total revenue minus just the cost of goods sold. So this is essentially how much profit the company is making on each item they sell. So if a grocery store purchases a bag of apples for $1 and then sells them for $3, their gross profit on that transaction is $2. And then there's also operating profit, which is how much profit is left over after deducting operating expenses, such as marketing costs, wages paid to employees, utilities costs, and also depreciation, which is just the wear and tear on equipment, and other costs that are necessary to running a business. Also, by the way, another very common earnings metric used in the investing world is what's called EBITDA, which is just an acronym for earnings before interest, taxes, depreciation, and amortization. And just to quickly explain what depreciation and amortization are, they're referring to wear and tear on certain assets such as equipment, because it's generally regarded that equipment becomes worth less and less the more it gets used. So, in other words, it depreciates. So, this is an expense that's designed to capture that natural depreciation. It's not actual money the company is paying, it's just reducing the value of equipment. And the reason this financial statement is prepared first is because the net income number ties into all other financial statements. So the next financial statement is the statement of retained earnings. Now, this statement can get really complicated for larger companies, but I'm going to keep things simple here and just explain the basics of it. So the basic retained earnings calculation is the balance of retained earnings from the prior year plus current year's net income. And if the company paid any dividends, a dividend being payments to the shareholders of the company as a way of paying out some of the company's profits into the pockets of those shareholders, then you would subtract the amount of dividends paid. So this financial statement is super simple in its basic form. It gets a lot more complicated with much larger companies, which we won't go into here, but basically you just take the retained earnings balance from the previous year, you add the current year's net income, subtract any dividends the company pays, and then you're left with the current year's retained earnings balance. And then you need this retained earnings balance to appear on the next financial statement, which we'll talk about. And this is the balance sheet, which is also referred to as the statement of financial position. And what it is essentially a snapshot of the balances of the assets that a company owns and the liabilities that they owe, along with any equity balances. And now I'll explain what all those things are. So, the important thing to note is that items on the balance sheet represent the balance of that account at a specific point in time, which is usually indicated at the top of the financial statement. So, unlike the income statement, where the numbers represent totals accumulated throughout the year, these numbers just report balances at a point in time. And these balances are constantly changing throughout the year as the company engages in various forms of transactions. So, I could talk about the ins and outs of the balance sheet for hours, but I'll keep things super simple here and just give you the basic level knowledge. So you will always find your assets listed first. This is all the stuff that the company owns legal title to and is expected to generate future benefits for the company. So everything from cash in the bank to accounts receivable being, in other words, money that the company is owed, to equipment the company has purchased to run their day to day operations, and so on. And then after that, you will have your liabilities, which is stuff the company owes. So these include amounts like accounts payable, which is the opposite of accounts receivable, in that it's money the company owes to other entities. And you'll also find any debt the company has in the liabilities section. And both assets and liabilities are classified as either current or non current. The distinction here is that current assets and current liabilities are expected to either be converted into cash in the case of an asset or paid for and settled with cash in the case of a liability within 1 year or less. So that's the distinction, whether or not it will change form in 1 year or less. So anything that's non current means greater than 1 year. For example, long term debt that isn't repayable until 5 years into the future is an example of a non current liability. And then, of course, you have your equity section, which is where certain items such as investments made in the company get recorded, as well as retained earnings, like we calculated in the previous financial statement, the retained earnings financial statement. And you can essentially interpret retained earnings as profit that the company has reinvested into the business. And the key calculation here, which also happens to be the major calculation that all accounting is based on, is assets equals liabilities plus shareholders' equity. And these items must always balance. So if they ever don't, then you know someone messed up. And really, the way you should view the balance sheet is to see how the company financed the purchase of these assets that are then used in their day to day operations. Did they finance the assets by creating liabilities, or was it by issuing equity, either from receiving investments from investors in the company or through reinvesting previously generated profits back into the business to then purchase more assets and expand it? That's essentially what this financial statement is designed to help you analyze. Okay, last financial statement is the cash flow statement, otherwise known as the statement of cash flows, and we'll start by examining this by actually looking at the bottom of the financial statement, where we can see how much cash the company went into the year with, and then how that balance changed by, and then how much cash they ended the year with. And the whole point of this financial statement is to see all the things that caused the cash balance to change throughout the year and kind of categorize them into different categories. And there are three categories here. So we have cash flows from operating activities, as in the company's operations, cash flows from investing activities, which in the case of a financial statement doesn't mean investing in stocks type thing. It means investing in things used in the business, such as equipment that you need to manufacture inventory that can then be sold, or investing in intellectual property rights. And then there's also cash flows from financing activities, which refers to the ways in which a company gets money to finance the purchase of their assets, again, such as their equipment and their inventory. And let's specifically take a look at the cash flows from operating activities section, as this section requires a bit more explanation. And we can see that it begins with net income, and then there are various adjustments made to that net income to get to the final amount, which is cash provided by or used in operating activities. There are several items that adjust this number. For example, any non-cash expenses that were deducted in the income statement need to be added back. So we talked about depreciation before and how depreciation isn't really an expense in that you're paying for it. It's just an accounting calculation that is designed to reflect the natural wear and tear on equipment, because it's generally regarded that equipment loses value over the duration that it's being used for. So there's no actual cash being paid for it. As I previously mentioned, just an accounting calculation that accounts for wear and tear. And there are various other examples of non-cash expenses that must get added back. And this section also includes the changes in the balance of certain assets, such as inventory and accounts receivable, as well as the changes in balances of liabilities, such as accounts payable. And the reason for this is because when you pay money to decrease a liability, you have to pay cash to do that. So this will naturally decrease the cash balance. On the other hand, when an asset decreases, usually it gets converted into cash. So then it increases the cash balance and vice versa. So I hope you guys found this video informative. If you did, please let me know by leaving a like. Or if you think this video sucked and you hated it, then you can also let me know that in the comments. And with that in mind, I'll see you in the next video. So thank you for listening.